All right, let's dive right in. Today, we're taking a close look at a company that is, frankly, a quiet giant in the tech world, Constellation Software. We're going to be working off a really detailed equity report from Morningstar to unpack a fascinating puzzle. And that is, how can a company with a near-perfect strategy still seem to be, well, misunderstood by the market? Let's get into it.
So right off the bat, you see this really interesting contradiction. I mean, look at this. On the one hand, Morningstar gives Constellation its highest possible grade for how it manages its money. Exemplary. But then you look at the stock rating, and it's considered undervalued. How does that work? That's the mystery right there.
So, yeah, that is the central question for this whole explainer. How can a company be so good at what it does, an absolute master of its strategy, and yet the market might be getting the price wrong? Let's start putting the pieces together.
And to solve that puzzle, we have to start at square one. What does this company actually do? Because Constellation's business model, it's really not like any other software company you've probably heard of. Okay, so their whole universe is built on this thing called vertical market software, or VMS. Now, this is not software for everybody, like Microsoft Office or something. Think of it more like super specialized tools for a very specific job. Software that helps run a specific type of factory or manages appointments for a chain of dental offices. For these little niche businesses, this software is absolutely mission critical.
And here's the kicker. Constellation doesn't just play in one of these little markets. Oh no, it's a massive holding company that has bought over 1,000 of them. 1,000. That number, that incredible scale, is really the key to understanding everything else about them. And this is their secret sauce, the playbook they have perfected. It's simple, but it's genius. Step 1, they find and buy these small, super stable software companies. Step 2, they let them run on their own. They don't meddle. Step 3, all the extra cash those businesses make flows back up to HQ. And step 4, well, they take all that cash and go out and buy even more businesses. It's this incredible self-fueling flywheel.
So, now that we get the playbook, let's look at the optimistic view, the bull case for why someone would be really excited about this company. And it all comes down to the beautiful, relentless power of compounding.
The bulls will tell you there's a huge runway for growth here. Their list of potential companies to buy has ballooned to over 40,000. And as Constellation itself gets bigger, it's able to hunt for bigger fish, making larger acquisitions which could speed things up. The core idea here is that they've built this perfect machine that just vacuums up today's cash and uses it to buy tomorrow's cash-generating assets. It's beautiful. And that, well, that's the multi-billion-dollar question, isn't it? An engine like this is amazing, for sure. But every investor has to wonder, at some point, does it just get too big? Are there limits to this growth?
And that fundamental question leads us right into the other side of the story, the bear case. This is the argument that the very things that made Constellation a superstar, its huge size and its repeatable model, might actually become its biggest hurdles. So, the bears have a few big worries. First, could something like AI disrupt everything, making it easier for new competitors to pop up and challenge these cozy niche software businesses? Second, and this is the big one, can you really scale this playbook forever? As they get bigger, they have to do bigger deals, and those bigger deals just might not have the same amazing returns. And finally, some folks are raising an eyebrow at certain big investments, like their growing stake in Sabre, a company that's carrying a whole lot of debt. So here's the whole debate in a nutshell. You've got the bulls, who see this proven, unstoppable compounding machine with a wide open road ahead. And then you have the bears, who see that road getting narrower with some pretty serious potential roadblocks, like new technology and the simple problem of being too big.
So, how does an analyst decide between these two stories? Well, the answer lies a really important concept called the economic moat.
So, what's an economic moat? Well, think of it literally, like a defensive moat around a castle. It's whatever a company has that protects it from competitors, a sustainable competitive advantage that lets it keep making great profits for a long, long time. And according to the Morningstar report, Constellation does have a moat. They call it a narrow moat. So maybe it's not the widest moat in the world, but it is real, and it's a durable advantage that should protect its profits for at least the next 10 years. But what's it made of? Okay, so the moat comes from two things. First, really high switching costs. Remember how we said this software is mission critical? Well, once a business is using it, ripping it out and replacing it is a massive, expensive headache. But the second source is even more interesting: intangible assets.
The report argues that after successfully buying and integrating over 1,000 companies, Constellation has built up an expertise that is almost impossible to copy. And this is the key insight. They're not just a software company. They're a world-class capital allocation machine that just happens to specialize in buying software companies.
Okay, so we get the business, we've heard the bull and bear arguments, we understand its competitive advantage. Let's get down to brass tacks. What's the stock actually worth?
Now, this is where the story gets really interesting. You can see the analyst's fair value estimate has been on a wild ride. It was jacked way up in June of 2025, but then it got cut in November. And listen to this. It was specifically because the company wasn't buying other companies as fast as expected. That is a direct nod to those bear concerns about scaling. And now, the current estimate sits at 3,600 Canadian dollars.
And this chart just shows it all so perfectly. You can see the stock price, that's the dotted line, was trading for a long time up in what the analyst thought was overvalued land. But more recently, the price has come down, even as that fair value estimate was also being adjusted. And the result? The stock price has now fallen right into that blue, undervalued territory. So this brings us right back to where we started. The bottom line of this whole analysis is that the stock's recent price of about $2,700 is a good bit below the analyst's fair value estimate of $3,600. And that gap, that's why it gets the undervalued rating we saw on that very first slide.
And all of this leaves us with one final huge question. Constellation's track record is without a doubt legendary. They have created an unbelievable amount of value by being the best in the world at one thing. But as the entire universe of technology shifts and accelerates, the core debate is still there. Is that legendary playbook, which was so perfect for the past, still the right one for the future? That's the question at the heart of it all. Thanks for joining me.